Hi, I'm Carla Dennis, and welcome back to my channel where I am talking to high income earners that receive W-2 wages, and I am going to be focusing on strategies to reduce your tax bill. By the end of this video, you're going to know exactly what you can do to lower your tax bill. But before we jump in, I'm going to need you to like, comment, and subscribe so you don't miss out on any of this wealth building information. So now, let's get after it. As a W-2 employee, one of the easiest things you should do is contribute to your company's 401k plan. If there is any type of retirement savings plan that your company offers, you are actually leaving money on the table without contributing to that retirement plan. I know many of you be thinking, Carla, I don't want to worry about retirement right now. But if you start to worry about retirement today, you will have a lot more money going further because you have the ability to utilize time. And this is something I want to make sure you understand. There is a fine point where you're going to give that money to the government or you're going to contribute to your own retirement plan. Find out that sweet spot. And most definitely, if your employer is matching what you contribute, you're really leaving money on the table. So you're overpaying taxes and you're leaving money on the table. And I already know you're a smart person, so you would not want to do that. Make sure you take advantage of that and contribute to your employer's retirement plan. And if you don't have a retirement plan, you go outside and secure one. Contribute to your own IRA, contribute to your own Roth IRA. But remember, a traditional IRA is tax deferred. Itemizing your deductions or taking a standard deduction as a W-2 wage earner, you really have to consider which one is best. Most of you who don't own a home probably think, let me just take the standard deduction. I don't want you just to rely on the standard deduction. Look every single year as to whether or not you qualify to do itemized deductions. Do you have healthcare costs that you can write off because it exceeds 7.5% of your income? Do you have charitable contributions because you're donating to a nonprofit or your church, or you're giving items to Goodwill or some other organization? Tangible items like clothing, furniture, and things of that nature. Don't throw anything away that may be usable. I don't care if it's pots, pans, that might be usable to somebody else, and you can get a tax deduction for it. You can also deduct your state income taxes up to $10,000 per year, and any type of state income taxes, property taxes, and things of that nature. And I know that employee expenses have been taken away on the federal side of the equation, but if you still incur employee expenses, you have to use your car on the job. That's not commuting to the job. If you have to buy certain things from work, your state may still allow that tax deduction. In the state of California, we still allow that tax deduction. So make sure you know the rules and figure out if you should itemize or take the standard, because you could be leaving money on the table and giving Uncle Sam a tip. And why would you want to do that? Tax credits are so important. And I know you probably don't even think about tax credits. Let me explain it to you. There's a thing called tax deduction, which means, for example, if I have charitable contributions, I'm going to deduct that from my income if I itemize. Or if I own a business, I'm going to take my car deduction against my income. So that is a deduction against income. But a credit is dollar for dollar. A credit is like you put additional tax into the system. It's like IRS is giving you tax. And how often does IRS give us anything? Come on now. So you have got to focus on tax credits. Allow me to give you an example. There is the child tax credit. There's educational credits. There's energy credits. There's credits for investing. There's credits for hiring. There's so many credits. But here's the thing. We're not taught to think about credits. You know why? Because credits are dollar for dollar. If I owe IRS $4,000, $5,000, $10,000, and I can get an energy credit of say $7,500, that is like me paying $7,500 towards my tax. And some of these credits are refundable, meaning even if you don't owe tax, they will put money back in your pocket. Be aware of tax credits. And they have credits oftentimes at the state level that are not even at the federal level. So you need to stop leaving money on the table. And if you want to leave money on the table, comment, Carla, I'm leaving money on the table so that I could get a little bit of that money. I'll go find it. That's right. We can't leave money on the table. Tax deductible benefits is another area you have to look at. If you work for somebody where you're getting a W-2, does that employer have a health savings account, an HSA? I know it may be confusing for you, but if you are paying out of pocket for any type of medical cost, a co-payment to go to the doctor, prescriptions, things for you going to go get Tylenol, things of that nature, if you set up a health savings account and allow them to take money out of your check every time you're paid, then you can get reimbursed that money whenever you pay for your medical expenses. That means that you get tax-free medical expenses, people. All of us have to go through the doctor every now and then. Why should we be taxed on that money too when there's an avenue for you to reduce your tax bill? Many of us just don't understand it because there's two ways to get your medical expenses to be tax-free. One is you're able to take a deduction as an itemized deduction, but it has to exceed 7.5% of our income. Most of us don't qualify for that unless we're having some type of major health issue. But on the flip side of that, if you have a health savings account where I say, okay, I'm going to set aside $2,000 for the year. Therefore, anytime I get a prescription, a copay, anything of that nature, I'm going to then get reimbursed back through my health savings account. That's $2,000 worth of tax-free money. It may not seem like a lot, but if you're in the 15% tax bracket, the 27% tax bracket, think about it for a minute. That is money that you can use to take me out to dinner or to send me some flowers. I love that type of stuff. Or maybe take yourself out to dinner or send yourself some flowers or your girls some flowers. Girls, don't send guys flowers because they don't like that. Anyway, you know what I mean. Don't leave money on the table. Think about it. Take the time to understand. Health savings accounts, flexible spending accounts, those types of accounts really are helpful to lower your W-2 wages. Tax loss harvesting is also a method in which you can lower your taxes. If you invest in the stock market, if you have any money in the stock market, and say it's almost December 31st, because everything has to happen before December 31st. If your stock account is sitting at a loss, go ahead and sell that stock and recognize that loss because you are able to deduct up to $3,000 of losses on your tax return against your W-2 wages. You already have a loss in your account. It only gets recognized if you sell off your stock. Sell, wait 30 days and buy it back. But get that tax deduction so that you can benefit from that loss and continue to invest in the market. W-2 wage earners, we got to start being smart about the things that we are doing to reduce our tax. Turn a hobby into a business. A lot of you are very creative out there. A lot of you are already getting paid for what it is that you are doing. I know you are. Why not make that a legitimate business? You're in the pursuit of income, keyword, report what people pay you. That's right, report what people pay you. Stop that under the table thing, that cash thing, and IRS don't know about it thing. Don't do that. Report your income. Guess what? You can now take all of your deductions. You can write off possibly a home office, possibly your car, your internet, and other things that you are doing to generate that income. But you can only do that if you legitimize that hobby and make it a legitimate business. Get a business license, set up a Schedule C on your income tax return, which is a sole proprietor form. The law says that you can take a loss 3 out of the 5 years as long as you're in pursuit of income. IRS can come in after 3 years and see if it's a hobby or a loss, which is why it's so important to get a business license, so important to document, so important to keep track of those receipts and show the money that you're making. Because I'm sure at the end of the day, you're probably losing money, but that loss can go against your W-2 income and reduce your taxable wages because you're spending the money anyway. Therefore, W-2 wage earners, you absolutely gotta get smart about reducing your overall tax bill. If you don't know what to do, I want you to comment tax professional in the comments, and my team will reach out to you and help you get educated on what you need to do. But right now, the most important thing is to make sure you take advantage of your 401k plan in your office. Make sure you're doing itemized deductions and not just taking a standard deduction, looking at whether a health savings account or a flexible spending account is good for you. Turn a hobby into a business, making sure that you're documenting, harvesting those losses. If you have losses in your stock account, you need to make certain you're doing everything that you need to do to reduce your tax bill. And I'm gonna make certain you're doing everything you need to do to reduce your overall tax bill. That's why when you know better, you gotta do better. I'm gonna need you to like, I'm gonna need you to comment, and I'm gonna need you to subscribe so you don't miss out on this wealth building information. Now, go get after it.